Hey, it's Seth and Paul for Everything Money again. We welcome you back to the show. What, Paul? What's so funny?
Again, this is the third time we've tried to
We're here. We're laughing. We're talking about Alibaba versus Amazon today.
So Amazon and I have a long history. I was wrong on Amazon. It's one of the few companies that can actually bona fide say, Paul, you were wrong. And the reason being is when I thought it was overpriced, my value is now currently above that. And this is what can happen in value investing, guys. The values can, if the market stays euphoric for too long, values can increase before stock prices decrease.
I owned a ton of Amazon, Paul. Yeah. You talked me out of it.
We're going to look at the numbers later. You know, Amazon is just a high-flying company. Last year during the pandemic, what was everybody doing? They're buying online. So Amazon's price skyrocketed. But the funny thing is about Amazon is their biggest margin, most of their money is made off of Amazon Web Services, not their actual retail stuff.
Oh, I didn't know that.
Oh, yeah. It's like, I mean, I have to look at the exact numbers and look at the 10K to see. But AWS is their big money maker.
What is that again? What does it do?
It's servers. Tim can probably explain it better than I can. Our developers know it. We use it for running all of our programs. Like Everything Money software is run on AWS, right? And Dynasty Owner.
Oh, wow, okay.
So we run, and all of our basic websites are run off of there. So it's a very high margin. But obviously with that comes a lot of competition. Now, you know, Microsoft, Google, all the big players, Oracle, they now have the same kind of thing going.
Do you want to get into Alibaba first? People love this company. I mean, they see it as a big growth company. You know, they're very excited about it. I say we take a look at the numbers.
Let's take a look at it.
Look at this ticker, though. Look at that.
What do you mean?
Oh, it's just down a bit. I'm surprised.
Oh, well, I mean, it happens. I mean, this is what happens. 10 years.
Oh, okay.
That's pretty good.
There you go.
It hasn't been around for 10 years, but okay. So market cap, $618 billion. All right, 26 PE, that's an X. Very healthy profit margin, 21%, that's a check. Okay, no dividend. Pretty decent return on assets and return on invested capital. So far, 1X, one check. Quote unquote expensive. Now keep in mind, their PE is 26. When Amazon was at 300, I don't think they were even making money at that point. So they had no PE. Now, let's go look at the revenue growth. Look at this, Seth.
Oh, boy.
24 billion to 111 billion. Is that a check?
Check, please.
Yes.
Yeah, I think so.
Net income.
Profit growth over the past 5 years. Pillar number 4.
6.7 to 23.3. Check mark there.
Yep.
Oh, my gosh. Okay.
So their profit margin is actually down a little bit over the last year because even though the profit's up, the revenue is up significantly.
So we have an X on PE at 26, but the rest are really great.
Yep. Now we have shares outstanding. 2.56 to 2.71. That's an X as well. Okay, so shares outstanding. It's not by much, about 6 or 7%. Not a ton, but it's still there. Balance sheet, $100 billion in cash, $58 billion in liabilities, and they actually have enough cash on hand to pay off all their liabilities. So financially, guys, the balance sheet is very, very healthy. They have enough cash on hand to pay off all the company's debts. So to repeat that for people who may not understand what that means your cash in your bank account could pay off your home mortgage, your car note, your student loans, every single bill you have outstanding for your entire life paid off just with a stroke of a pen. And you'd still own everything else. Okay, that's pretty impressive.
This wonderful software behind Paul is a part of our Patreon. If you join the Patreon today, you can have this software right now. You can join our community of over 3,600 users from around the world, all like-minded, disciplined investors who are looking to strengthen their financial knowledge and their investing knowledge. You get the software, you get the Discord community, and all for 80 cents a day, right, Paul?
Yep, around 80, 90 cents a day.
Yep. So if you feel alone out there and you've never been on Patreon, click the link below and join our Patreon. You can get access to the software. Go ahead, Paul.
All right, now guys, free cash flow
is
cash from operations less your capital expenditures, right?
This is our pillar number 7.
The way Alibaba reports, we have to go based on their ending annual return, their ending annual report, okay? So I'm going to skip last year because we don't have a capital expenditure here so far. But if going back to the previous years, 7.1 billion to 20.9. Now guys, I added this line for our users. This is not in the normal investing section of the cash flow statement. Usually it just says cash from operations above it, capital expenditures, you gotta do the math. I saved you time. 7 to 20.9, and this average includes last year, so the average is roughly, call it 15 billion. 15 billion times 20 is $300 billion. So it's expensive.
Yeah, the current market cap is $618 billion.
Correct. Sounds really expensive, but guys, remember, this is greatly increasing at a very fast rate. So to sit there and take the average of the last 5 years, if you believe the future years are going to keep growing, is an unfair assessment.
Yeah.
You've got to give it a higher multiple than just 20. So for those of you out there who say, Paul doesn't care about growth, I absolutely 100% care about growth. This is a prime example. You were cutting Alibaba short by only factoring in the average of the last 5 years, right? Mm-hmm. If you just look at the last full year we have, 21, it's selling for about 30 times free cash flow as opposed to over 40 times the last 5-year average, right? Mm-hmm. So is it expensive? Well, we're going to input it in the stock analyzer tool. It can tell us then how expensive or cheap it is based on the growth rate.
So we're still designing our stock analyzer tool for you patrons. You'll get that later this summer. But Paul, go back to the basis of stock analyzer. This Excel spreadsheet, this wonderful Excel spreadsheet that you've shown us for the past year. People love this thing. You've turned this into a website, but show us what this means, what you're going to do with Baba.
Well, that's exactly what happened. I had this Excel sheet and people would say, how do I get the Excel sheet? So I was like, okay. So what it does is it gives you the data on growth rates. It gives you the data on profit margin. It gives you all this data and says, come over here and make assumptions. I asked for 3 different assumptions for revenue growth, share buyback rate, and profit margin, okay?
So share buyback, is this important to you? I mean, so many people laugh this off.
It's the silent killer. Oh, they don't get it. And for people who don't care about share buy, like I just saw an article about Carnival Cruise Line issuing another $500 million, 500 million shares, $500 million worth of shares. I look at it going, it's $500 million worth of shares. I look at it going, guys, this is, you're being diluted as an investor. If a company's profit doubles, but the number of shares they have outstanding doubles, you've got no benefit from it. Because now you're being split amongst twice as many shares. And this is different than a stock split. A stock split is you have 10 shares, they now give you another 10, you have 20 shares now. Share dilution and issuing more shares is you have 10 shares out of 100, but they issue 100 more shares. Now you have 10 shares out of 200 shares. You went from 10% ownership down to 5%. This is a very silent killer. People don't pay attention to it, but it's important to understand, okay? So it does profit margin as well, asks you for your net present value, which is your desired return, and a future PE. Guys, Alibaba, it's insane. Based on these growth rates, if you assume the growth rates are gonna stay stable, I have a low price of 408 and a high price of 680, and the stock is currently at 230.
Yes, 230.
So this might be a buy based on the growth rate. This is what matters. This growth rate is insane. These profit margins are great. So you have to sit there, and if you believe these growth rates are sustainable for the next 5 or 7 years, even a 40% discount to growth, even if you think they can still grow at 30% a year, now the question is, can they actually do that? As a value investor, I'd be a little more conservative. And I'd sit there and say, let's do a 60% drop in growth rate. Guess what? It's still selling for...
right on par.
Right there.
So this hasn't happened often, Paul, where our market cap is double what we think it might be, but then you...
Why is that?
I don't know. I'm confused.
Growth rate.
Oh.
Remember, if you have a high growth rate and you perceive a high growth rate to happen, it can make up for an overpriced company. As an example, if every company in the market is selling for 15 times earnings, but one company is growing at 20% and one company isn't growing, which one would you pay more for?
Sure, of course, the one that's growing.
Of course, the one that's growing. I mean, all things being equal, the one that's growing, right? And that's all we're doing here. The growth rate's what drives everything. And this is the big thing in value investing that people think is, oh, it's so boring. It absolutely factors in growth rate.
Yeah,
I mean, it's a very common thing.
I think in this case, you know, other YouTubers love hyping up growth stocks in their, what is it, pre-revenue state where they don't make any money. They've been making nice money for many years now. And so, you know, I don't think this falls in the same category as like one of these growth stocks that you get blasted for not really believing in, Paul. I mean, the proof's in the pudding here with the numbers, wouldn't you say?
Yeah. And that's all I sit there and tell people is growth matters, but paying a reasonable price for growth is what matters the most.
Yep.
And that's all I'm doing different. Every other YouTuber out there will sit there and say, well, it's going to the moon, so pay whatever price. They don't say that that's what they're saying, but it is what they're saying. When they have no reason for why this price is good versus that pricing being good, then they're willing to pay any price. They might sit there and say, well, no, I wouldn't pay triple this. Well, yeah, you would, because if it tripled, you'd probably be like, well, it tripled, so it's probably a good price at a higher rate. I'm just sitting there saying, everything is good or bad based on what price you pay. Every investment is good or bad based on what price you pay. That's it.
Shall we compare this to Amazon?
Let's go compare it to
Now,
Amazon.
you use Amazon for everything. All the ointments and jellies that you order, your dog food, all the little things.
Yeah, and by the way, the last ointments that I ordered, they came out wrong. And they came back and forget it.
Wrong hole? Keep going, Paul.
Oh, boy.
Okay, go ahead.
All right, Amazon almost triple the market cap, 1.7 trillion.
Oh, my God.
PE of 64, also almost triple. Profit margin of 6.4%, 1/3. So guys, triple the market cap, almost like 2.5 times the PE, and 1/3 the profit margin. Off to a bad start so far. No dividend, and very low, about the same return on assets. Okay, let's go look at the income statement.
Revenue growth.
142 to 419. Check mark there.
Check, please.
Okay, how about profit growth? That's huge.
Profit growth.
Huge.
2.6
Oh
to
my
27 billion.
Yep.
Check mark there.
Oh, my gosh.
Yeah, I mean, they're making money hand over fist right now. Shares outstanding. 477 to 504. And they've been issuing shares every year for the last probably 20 years. Because they've been so expensive, it's justifiable. I mean, issue more shares instead of taking on debt. When a company's stock is overpriced, would you rather have them selling overpriced shares out to suckers, or would you rather have them taking on debt that you have to be responsible for? It actually can make sense to dilute shareholders when the stock is amazingly overpriced. So,
Pillar number 6, assets over liabilities.
121 versus 115, barely a check. Their balance sheet's not nearly as good as Alibaba's, but still they can pay their bills.
How about free cash flow?
So free cash flow. Ready, guys?
Oh, boy.
8.76 to 22, that's a check mark, which average of 15. 15 times 20 is 300 billion. That's an X.
Market cap is 17. What is this?
1.7 trillion. So even on the market cap of 1.7 trillion divided by 22 last year, you're still 80 times free cash flow on the last year. So guys, Amazon. One thing I want you to understand about Amazon is everybody uses Amazon to buy goods. I would encourage you to look at the 10K and figure out what percentage of their profit comes from selling goods versus their AWS servers, things like that. Are they still making money on it? I'm sure they are. I didn't realize they made 26 billion last year, but they also had a fluke year last year because everybody and their, oh, did I tell you the Amazon story?
Go ahead.
Guys, great story. The other day at my new house, and I'm sweeping up like the cleaner that I am.
Yeah.
And the Amazon guy comes up. He's in his Amazon Prime outfit. Amazon truck is there delivering something. So I said, hey, question for you. Because I'm very fortunate to have a gate in my house and I haven't closed the gates yet, but I want to. And then I want to put a box outside so that Amazon people can deliver. So I said to him, hey, I want to do this, blah, blah, blah. Do you have any suggestions? He goes, I really don't know. I go, oh, I'm like, well, what do you use at your house? And he goes, I swear to you,
Go on.
I've never bought anything from Amazon before.
The Amazon driver?
The Amazon driver who might be 30 years old, high side. And I just look at him and go, what? He goes, yeah. I go, you work for Amazon. Forget about that. You're 30-something years old. He's like, I've never bought anything from Amazon before because I don't have an account, nothing. My mind was fried.
You will be fried as well. Nate, check out my computer right here. I'm on the 8 Pillar website you get as being a Patreon. And look at this, Paul. You mentioned the 10K, and boom, I go right down to annual reports. And just like that, I can click on the most current 10K and look up everything Amazon. That's incredible, Paul. This website's awesome. Everything money. All right, Paul, keep going.
So now Tim sent me the right link to the stock analyzer tool. So let's pull in Amazon over here and see what Amazon is worth over here. Because remember, Amazon is growing. And here are the revenue growth rates. It's actually been increasing over time, okay? Their share change, profit margin, also increasing. Free cash flow as a percentage of revenue. Their PE currently, their current price of free cash flow. I said it was 80, it's 78.7. Look how wrong I was. So let's put our assumptions in. This allows you to put in 3 assumptions, a low, middle, and high assumption. It'll give you 3 different prices. And the reason we do this is, it's not to sit there and say this is set in stone. It's to get you a feel for the company of saying, okay, are they anywhere close? Are they not close? So revenue growth. Let's go low end. See, guys, this is number of year analysis. I'm going to go on a 7-year analysis. The question you have to ask yourself is, what's a reasonable growth rate for the next 7 years for a company like Amazon?
In this,
I mean, it's hard because they did $400 billion already.
yeah.
Keep in mind, Walmart does 550. How many billions? I mean, they're almost going to be bigger than Walmart. And they already occupy over 50% of online sales, I believe. So I look at that saying, man, how much more can they, I mean, listen, let's do 15, 22.5, and 30%, which I think is really, really high. Share change. Let's go 0.5. Let's go 1. Let's go 1.5. Actually, should be the other way around. Profit margin. Their profit margin's increasing, and it will increase as AWI go up. So 4, 6, and 8. Free cash flow, 5. Let's go 6, and let's go 7. We shouldn't have this PE here. Oh, boy. Oh, no, we have to have the PE here. So let's pick a low PE. Now, here's where everybody differs.
Mm-hmm.
What PE do you want to assign to Amazon? Now, a lot of people out there, like the people who sit there and say that Tesla will be 70 times earnings in 10 years, this is where I find it to be difficult. 20, 40, 60. Price to free cash flow, it's currently 78. 20, 40, 60. Desired annual return. I want 15%. I want 12.5%. I want 10% return. Analyze.
You want your high at 10?
When you want a lower return, you're willing to pay a higher price.
Oh, got it.
That's why I did that. Great point, though, Seth.
Okay, keep going.
It gives me my values. Look at how insane these numbers are, guys. 13,000 is a high for the stock price. And here's what it's based on, though. 30% revenue growth. In 7 years, on 30% revenue growth, 1.3 to the 7th times 415 million? 415 billion? That's assuming they do $2.6 trillion in revenue in 7 years. 2.6 trillion in revenue in 7 years. Walmart is the biggest revenue company in the world at $550 billion. Guys, this is where I sit there and say, is this sustainable? I don't know. I don't think it is. Let's go back to Amazon's income statement. $420 billion it did last year. $420 billion. So it's assuming it's going to do $2.6 trillion. That's when I sit there and say, guys, instead of looking at the numbers, look at what your assumptions mean. $2.6 trillion. That means that Amazon would be over 1/10 of the US economy today. Literally 1/10 of the economy. Again, not trying to be Debbie Downer here, but Walmart, their revenue, $560 billion last year. Again, you might look at me and say, Paul, they could do $2.6 trillion, but just go figure out where that goes in terms of reality. Now, I do believe that even my low-end statement, my low-end analysis, it might be still aggressive. 15% revenue growth for 7 years, 1.15 to the 7th times $420 billion. It's still over $1 trillion in revenue in 7 years. 1.1 trillion. Is that possible? Of course it is. If anybody can do it, it's Amazon. But even on that, guys, it's still only worth $820 a share based on that method. And by the way, I used to always say, when people ask me, what do you think Amazon's worth? I go, 800? I used to say that, 800, 900 now, 600 to 1,000. Now you might be sitting there going, oh my God, look at 13,000, look at 11,000. But just think about what that entails. That entails Amazon doing 30% revenue a year. 30%. According to this, buy it all day. I just don't buy into this assumption. This is literally $2.4 trillion, $2.6 trillion in revenue a year. Revenue, guys. Keep in mind, what did Apple do last year in revenue? What did Apple do last year in revenue?
57.
No, that's profit.
Oh.
Revenue, they did $325 billion. They would be 8 times the size of Apple. Is it possible? I mean, it's possible. Is it probable? You can't assume the last 7 years are going to be the same as the next 7 years. I just have a hard time buying Amazon at $3,000 a share. I still think it's overpriced.
Well, and all this comes from the idea that you're a true value investor. You want to buy $1 for 50 cents, and if you at home are not,
by the way, I don't think $800 is buying $1 for 50 cents. I think it's buying $1 for about $1.
Oh, I see. So
I actually think it's worth about $800 to $1,000 a share.
Yeah.
I want to buy it at $400 or $500 a share.
Yeah.
Like Microsoft in 2012, 7 to 9 times earnings, and now it's selling for 30 times earnings.
Is this we talk about corrections, crashes. At one point, Amazon went from $112 down to $6-7. Is there anything stopping this train from going to the moon?
Just, guys, moods change all the time. Remember, every single time there's hype and euphoria, moods will change. And all of a sudden, Remember, Microsoft was the unstoppable. Microsoft and Dell and Cisco were the unstoppable companies of the late 90s. Within 10 years, they were all selling for a fraction of what they were worth, what they were selling for in 2000. Less than 10 years later. You look at that saying, guys, moods change all the time. Look at Tesla. Tesla was at $900 a share. Now it came and breaks $650. Does that mean that's it forever? No, but it was at $60 a share a year ago. All of a sudden it went up 10 times, and now at 15 times, now it's down a third. You just got to sit there. And my question to you is, are you the kind of person who wants to invest in hopes and dreams, or do you want to invest in likely scenarios and likely outcomes?
Yeah, very likely.
Just like in baseball. Are the best baseball players the ones who hit the most? So we don't even look at, we look at home runs as a fun thing anymore, but they used to be much more important than it is now. Now it's about who gets on base.
Yeah.
Who gets on base? The highest paid players are the ones who get on base. Yeah. That's it.
That's our take. Amazon is a no for us, but Alibaba is very intriguing, and we'll continue looking at these companies as the year progresses. We appreciate your support, watching the video all the way. Join the Patreon. You're going to love it. And that's our take. Love you. Love you, Paul.
Thank you very much.
Thanks. See you.